students? I want to go over closing entries with this video. First of all, what does that mean, closing? If you close out an account, it means you're going to make the balance equal to 0. Okay, now why would we do such a thing? So let's go back in time. If you recall, when we were deriving the rules for debits and credits, Luca Pacioli created the double entry accounting system. We got to the point where we had transactions involving revenue. Now in chapter 1, you were told that revenue increases capital, and that is true. But we did not put the transactions in the capital account, nor did we put the transactions involving drawing and expenses. And what was the reason for not putting those transactions in the capital account? The reason was that during the year, we wanted to keep track of revenue, expenses, and drawing. If we put everything in this account, there would be, first of all, it'd be zillion entries. And if you ever wanted to know what a particular expense, how much of a particular expense had been incurred, let's say rent expense, you'd have to go through all of these transactions. So we set up separate accounts for revenue and income, drawing, and all of the expenses to keep track of these items. That's the reason for creating a separate account. It's always the same reason, which is what? You want to keep track of that particular item. Now, we get to the end of the year, not the end of the month, the end of the accounting year for the company. For sole proprietorship, that's going to be December 31st. Okay. Now, we kept track of revenue, expenses, and drawing throughout the year. Now what we'd like to do is to put those transactions somehow, or the effect of those transactions, in the capital account. And that's going to be accomplished with closing entries. Okay, so let's see, where are we? This is a simple company. They don't like a lot of details. Too many details gives them a migraine. So this is an adjusted trial balance. So we have to play make-believe that what? That all of the daily recurring journal entries have been recorded and posted, and that all of the adjusting journal entries have been recorded and posted. And this is the final product. These are the end of the year numbers. We want to go into 2021 now and start this whole process over again. So what we want to do is to get all of this activity in here into the capital account, where we could have put it in the first place, yeah, but we did not because we want to keep track of these items. All right, so let's see. Closing entry number 1. I want to make the balance and fees earned disappear. All right, so how do we do that? Well, it's got a credit balance. So in order to make the balance 0, we're going to need a debit. So I'm going to come over here. This is going to be C1. It's my first closing entry. I want to debit the revenue account, fees earned. And what does that do? Well, that reduces the account balance, yeah? And the balance is $13,000, so that's what I'll use for my debit. Now, contrary to what they have in the book, we're going to use an artificial account called income summary, which is only used during the closing process. It's created and then it's eliminated in this process. Well, let's see what happens. This is an artificial account. It says income summary. So guess what it's going to summarize? Correct. It's going to summarize your income. All right, so let's post this transaction now. It's going to be a debit to the revenue account, $13,000. We'll call that what? C1. And it's going to be a credit to income summary, artificial account used in the closing process. All right. Now, what's the balance in fees earned? Well, the balance is now 0. Okay. Now, next thing we want to do is close out all of the expense accounts. All the expense accounts, that's the yellow rectangles, have debit balances. So if you want to eliminate those balances, you're going to need to credit those accounts. So what are our accounts? We have rent expense. We have telephone expense. We have supplies expense. So we're going to have 3 credits. What if you had 30 accounts? Well, you'd have 30 credits. Okay, so what's the balance in rent expense? $4,000. I want to get rid of it. It's got a debit balance. I need a credit to make it go away. Credit telephone expense. Credit supplies expense. So what's the sum of these? That's going to go to income summary. $6,800. Okay. Now what? All right, let's post these. Let's put the 4,000 over here. I'll call that C2. What's the balance in rent expense? It's obviously going to be what? 0. Okay. 1,500 supplies. Whoops. 1,500 supplies. C2. That's telephone. This is supplies. Well, you know what's going on here, right? Okay. So there's your 3 credits, leaving us with a balance of 0 in the 3 expense accounts. And where does the debit go? Well, the debit goes to this artificial account, income summary. And that's going to be what? $6,800. This number over here. Okay. Now, let's see, what do we have? We have zeros in our revenue and expense accounts. We have a $6,200 balance in income summary. This 13 is the revenue, yeah? And this is all of the expenses. And you, being the star accounting student, you ought to realize that, well, the difference between the revenue and the expenses is equal to what? That's equal to the net income, yeah? At least it's net income in this case. Why is it net income? Because you have more revenue than expenses. Could it have gone the other way? Could you have a debit balance? Yes, you could have had a debit balance, in which case it would be a net loss. But that's what we have. We have $6,200, which is the net income, which is the difference between the sum of our revenue account or accounts and the sum of our expense accounts. Could you have more than one revenue account? Yes, you could. You could have rental income as an example. All right, now what? Let's go on to number 3. Number 3 you want to do is to eliminate the income summary account and update capital. Now, income summary at this point has a $6,200 credit balance. If you want to make it 0, we're going to need a debit. Yeah? Okay, so we'll debit income summary for the balance, which is $6,200, and we'll credit the capital account for $6,200. What's that going to do? That is going to make the balance in income summary 0. Yeah? And what else will happen? Let's drop the C3 over here, 6,200 into the capital account. Now what just happened there? Well, first of all, should be pretty obvious. We have no balances in these accounts. What accounts? The revenue and expenses. Second of all, we now have the effect of all of the transactions throughout the entire year for revenue accounts and expense accounts is now put into the capital account with one entry for the net income. So that's 6,200. Obviously, this is a Mickey Mouse example, but imagine in the real world, that could be the result of thousands of transactions. And going into this account in one shot, is your net income. So that's as if what? As if all of that stuff had been put into the capital account in the first place, which is where we told you it either increases or decreases in Chapter 1. Okay. All right. So now we have zero balances in these revenue and expenses. And then the last thing we want to do is get rid of the drawing account, which is also a temporary account. I'll come back to that in a minute. So drawing has a $700 debit balance, and we want to get rid of it. What do? We credit drawing, and we debit capital. That's where we could have put it in the first place, right? But we didn't, because we wanted to track drawing throughout the entire year. All right, let's post this one up and see what happens. Drawing, $700. C4. What's the balance? 0. Okay, and then the other half of that entry goes over here. $700. C4. Okay. All right, drawing's got a 0 balance now. What's the balance in capital? It's the pre-closing balance plus the net income minus the drawing. $7,500 is the balance. So there's the last little piece, right? Now, all of the transactions that we could have put in the capital account in the first place, the account has been adjusted for all those transactions at this point. All right, but we had the benefit of, throughout the entire accounting year, of keeping track of all of our revenue accounts and our expense accounts and the drawing account. And that's why they're called temporary accounts, because they have a shelf life, which is a maximum of 1 year. And when you get to the end of the accounting year, we zero these out, otherwise known as closing out. We close out the balances in these accounts. And what are we going to do next? Well, we're going to repeat this process in 2021, starting with zeros in all of these temporary accounts. So in 2021, we'll keep track of the same accounts, and then we get to the end and we do the closing process. And we do this over and over again until what? Until you can't take it anymore. Okay, so here's our 4 closing entries. Now let's see. Where are we now after we do all of the closing entries? I think I have a little thing down here. Let me see. Oh, there it is. Simple company. This is the so-called post-closing trial balance. That's what they call it in the textbooks typically. All right. So what's the balance? What are the balances? Well, these are our permanent accounts, right? Cash, those unchanged. Receivables, supplies, payables. And the only account that changed that was permanent in nature is the capital account, which was updated for what? For all the stuff we could have put there in the first place. So what kind of balances do we have? We have the updated capital balance of $7,500, and we got all zeros in these accounts. Those are the temporary accounts. And there are the post-closing balances. So you go into 2021, what do? You start over again. Same process. Collect the information on these items during the year. You get to the end of the year. Put all that into the capital account. Now in the real world, do you actually do all this debiting and crediting stuff over here? No, you do not, okay, because you're using a computer to do all your accounting. But in order to use computer software to do accounting, you need to know what the underlying principles are. So I could give you my tax software as an example, which does all kind of wonderful things, but since you don't know anything about the tax laws, it would be basically unusable to you. So that's what we need to do. You need to understand what's happening within the confines of software. So how do you do this if you're using accounting software? Well, typically you use a function, close fiscal year. That's what it is on the software that I use. And within a few clicks and so forth, you wind up with what? In seconds, all of this stuff is electronically vacuumed up and put into the capital account for sole proprietorship. Corporations, that's next semester, would go into an account called retained earnings. That's how it works. There's Luca's double entry accounting system. Those are the closing entries. Hopefully it's not a mystery at this point. I remember when I first realized what these closing entries were doing as a student, and I thought to myself, why didn't the teacher show it like this so I could see exactly what's going on? Well, here it is. I hope you got something out of this, and I'll have another video coming up having to do with merchandising activity. Until then, enjoy.